Hey, good morning, everyone. Marty Mazora here. Tuesday, November 12th, 2019. Going to keep this video quick. It's going to be different than what you're used to. No market graphs today. I tell you, the market graphs are getting boring. I would just show you ascending wedge patterns, negative divergences on the hourly, daily, weekly, monthly charts. The market looks like a correction, or I should say a technical setup for a correction, just waiting for a catalyst. And who knows, if and when that's going to come. We'll continue to monitor that and so on. It's interesting, and I think it's instructive to give our clients a view for what the near term may have in store. It's important to us too, particularly when we have concerns about what lies under the surface. A substantial correction in the market could actually precipitate the next bear market / recession, and what I've been showing you of late under the surface, particularly in the corporate debt market, is troubling. And so we are playing it safe for a number of reasons. The market is kind of all over the place this morning. The Dow is slightly in the negative right now. S&P is still a few points in the positive. The president spoke at the New York Economics Club, and he spoke accurately about the strength of the U.S. consumer. I appreciate that because the consumer data is still relatively strong. He did talk it up, perhaps more than the latest data would justify, but that's okay. That's what presidents do. Problem is, under the surface, the other data, the stuff that's got our index in the red, is ultimately going to be consumer impacting stuff if it keeps up. Anyway, I wanted to show you what you see on your screen there. I find this quite interesting, and I'm thinking that you may as well. Last night I was stress testing portfolios, and I wanted to show you just this simple chart. What the green bar here is our current equity weighting for clients, or I should say our target weightings. The blue is the S&P 500, the orange is the NASDAQ Composite Index. And these are obviously, notable corrections and bear markets of recent history. Now, keep in mind, folks, our allocation right now still reflects the bull market and the expansion that we are still in. But you clients, as you know, we now have our exposure either hedged or we've cut exposure, depending on the size of the client's portfolio. But our targets for the equity exposure that we have is still that. But if we were unhedged and we were to run into the Russia default and the long-term capital management, biggest hedge fund of its time in '98 implosion, we'd be looking at about a 20% decline, about what the S&P did. NASDAQ was down almost 30%. If we were to run into the tech bubble today, our target weighting, all the stocks in the portfolio would be down about 34%, while the S&P was down almost 50%, and the NASDAQ Composite was down 77%. The Great Recession, the subprime crisis, our allocation would be down 56%, S&P down 56%, NASDAQ down 55%. Last year's correction, our allocation to stocks down 18%, S&P down 20%, NASDAQ down 23%. Okay, so what I find interesting, though, is just the timelines between these. So I want to show you that, and then I want to talk just briefly about current conditions. So from before this correction in here to the peak of the market, this longest bull market and frankly the longest expansion in history. Then we peaked, we had the tech bubble burst, and then from the bottom of the market to the peak was only about 5 years, a little better than 5 years. You might say from the end of the recession to here was more like 7, but the actual market, trough to peak was about 5. And then here we are, folks, today experiencing now the longest bull market expansion in history. So this one is now number 2. We're now experiencing the longest ever. Now, the period between the Russia default, long-term capital management debacle, and the peak was about 15, 16 months or so. We had this correction, market rebounded, new all-time highs, and then we finally rolled over and had one whale of a bear market. Folks, we're about 11 months out from the bottom of this one. It happened to be Christmas Eve. So 11 months ago is when we bottomed, and ironically, we were looking at, say 20% for the S&P. roughly the same back in here. So now I want to talk about conditions. Clients who've been with us, throughout all these, or at least over the last 10 years, know that while we went through these corrective phases back in here in 2010, the European debt crisis, the kind of almost nearly an industrial or manufacturing recession in here, last year's big correction, we pretty much stayed the course. We did not get defensive. We did not cut our allocations to equities. Why? Because general conditions were holding up just nicely. This is the back-tested score of our PWA macro index. This was the real-time score back here on December 24th when the market bottomed. And this was what it was back here in 1998 when the market bottomed. Ironically, same score. Came from different places, but again, the net score in the green to that extent says that conditions are okay despite the fact that there were some really scary things going on that caused the market to drop 20%. Well, again, the market came back and we had this 15 months or so between here and the peak. And I'll say it again, we're about 11 months out from here. So why now? Why are we being defensive here when we weren't in here? And of course the red number shows, and I know this isn't the first time regular viewers have seen this. So back in here when the market dipped, and I backtest our index right here, we had a negative 10. Now when I show this in client reviews, every time I say, now you may not like me, and this was leading up to this, because when we begin to turn in the red like this, we're going to have to start getting defensive. As you can see, history suggests that the market may very well rally nicely from that point. In fact, big rallies in both cases. Again, why would that be? Because of all the stimulus that's going on. Why are we getting this big rally right in here? Well, we're getting a very accommodative Fed that was not that accommodative actually at all right up in here. So the Fed is helping out and promising to, only raise interest rates if they have guns to their heads, essentially. Of course, I'm exaggerating. And then you've got the prospects for the ending of a trade war that I think is actually largely responsible for this dip that we had last year. And we've talked a lot about that. But regardless of what's causing it, folks, right now we have red numbers. You can see we've gone from red, this was about a 5-week stint, back to green for about 4 weeks, and now we're back in the red, a couple weeks in a row now with a -6. Not huge recessionary numbers, but enough to tell us that odds are better that we're going to morph into a near-term recession than they've been throughout this whole longest ever expansion. Plus, as I keep reiterating, under the surface, if we throw a spark down there upon all that gasoline in that corporate debt market, I think it's going to smell a lot like 2008, and I think we could get a similar result. So when we have this going on, which is heightened, rollover risk, and I think we're going to know in the next few months. Ironically, again, this was 15 months. This is 11 months out. I've shown you recently CEO sentiment versus consumer sentiment. The consumer is what is or who is holding up this economy. There's no doubt about it. While the employment numbers are as good as they've been, I think the consumer continues to hold up. CEO confidence is literally at recessionary levels. They are depressed in their outlook. They hire folks. So if that morphs in over the next few months into job cuts, I think that's probably the straw that breaks the camel's back. One other interesting statistic that I just stumbled on here the last few days is that August of this year, we saw more CEOs leave their positions than we have in any month in history. And year to date, believe it or not, more CEOs have exited their jobs than at this time in 2008. Typically, CEOs do not call it quits when they think that the expansion is going to continue and they're going to continue to make great money and they're going to get great bonuses. The last few years, a lot of this growth was fueled by share buybacks, which manufacturers really artificial earnings per share growth. And they've done that and they've benefited from it, certainly in their compensation packages. The fact that they're exiting right now has me wondering if they don't foresee something like this. So we'll see, folks. This is all speculation. Lots going to unfold over the next few months. Of course, we'll be here probably daily to bring it to you as it unfolds. Thank you, as always, for watching and listening. Talk to you again very soon. Bye-bye.